Hello everybody and welcome back to part 2 of our module 2 for the mechanics of bookkeeping and accounting. Let's talk about where we left off. We left off with the unadjusted trial balance, and now we're going to pick up with the adjusting entries and all of that process. We'll talk about the financial statements and then all the closing process. So before we get any further, let's talk about the difference between the cash basis of accounting and the accrual basis of accounting. With cash basis, we're basically recording both revenues and expenses when the cash changed hands. With the accrual basis of accounting, the cash changing hands doesn't matter. It's when did we earn the revenue, regardless of when we received it, and when did we incur the expense. In other words, when did we use up that underlying benefit, regardless of when the cash was paid. GAAP, generally accepted accounting principles, requires the use of the accrual basis of accounting. Now, in that situation, sometimes cash is paid or received before we can record it as a revenue or expense. Sometimes the cash payment or receipt happens after. And that's really what gives rise to these adjusting entries we're talking about. So let's see an example of this from the cash basis perspective. And we'll first talk about revenues. Revenues are recorded when cash is received under the cash basis of accounting. So let's say we are a magazine publisher. We sell a 2-year magazine subscription to subscribers in January of year 1 for $24,000 total, which is $1,000 per month. Under the cash basis of accounting, all $24,000 is recorded as revenue in year 1, even though part of the revenue is earned in year 2. Now let's take another example. We have services in the amount of $50,000 provided to customers in year 1, but we're not going to receive payment until year 2. Under the cash basis of accounting, all $50,000 would be recorded as revenue when collected in year 2, even though we actually earned the revenue in year 1 when we provided the services. So this basically shows a point that it seems like it's recording revenue in the wrong period. Here with the magazine subscription, a whole bunch of revenues are going to be recorded in year 1 with nothing left to be recorded in year 2. And here, it's just the wrong period. We earned it in year 1, but we didn't collect it until year 2, so that's when we record it under the cash basis of accounting. Let's look at this from the expense perspective. So we have a 1-year insurance policy purchased July of year 1. It's $2,400, $200 per month. Under the cash basis, all $2,400 is going to be recorded as expense in year 1, even though that insurance is actually benefiting us for part of year 1 and part of year 2. So you can see there are some issues there with potential timing. The accrual basis of accounting, which is required by GAAP, records revenues when they're earned. So in this situation with that 2-year magazine subscription, every month would record $1,000 of revenue as it's earned. So in this case, half of it would be in year 1, the other half would be year 2, because that's when we earned it. With that $50,000 example, we earned it in year 1, December, which is when we provided the service. So it doesn't matter that we collected cash later on. Year 1 is when we record it as revenue. With the expenses, $2,400, so it's $200 per month. Every month gets $200 of expense recorded, so half of it's going to go in year 1, half of it's going to go in year 2. Hopefully this has provided a pretty good example to show that there are reasons the cash basis is not allowed under GAAP. It's too subject to manipulation. It just mismatches when you record revenues with when you've actually done what's needed to earn them. It just doesn't accurately reflect the actual operations of the company. Therefore, the accrual basis is required. So that's an intro to adjusting entries, showing why we use the accrual basis of accounting. Now let's actually dig into the adjusting entries. We're journalizing, posting, and creating an adjusted trial balance, very similar to what we did with the original journal entries. Now the first thing to understand here is that the adjusting entries are performed at the end of the accounting period before we publish the financial statements. The whole goal of the adjusting entries is to convert to the accrual basis of accounting, and then to make sure that we have proper balances reported for all the income statement accounts and all the balance sheet accounts. That's really the goal. We want to correct for any sort of timing differences we have between the accrual and cash basis, and this is done through the adjusting entries. So now we need to talk about some categories of adjustments for this to make sense. We have two main categories. We have accruals, and then we have reclassifications, also known as deferrals. And it's all about what came first, the cash transaction, the receipt or payment, or the revenue or expense recognition. They're both going to exist at some point in time. It's just a question of which came first. So under the accrual situation, we need to force the revenue or expense recognition even though the cash payment and receipt has not yet happened. Recognition comes first. The cash transaction will come in a later period. Now, what I want to point out here is that when we're talking about adjusting entries, you need to understand that for every adjusting entry, there's also going to be a related cash entry that happened either before or after the adjusting entry. For accruals, the initial entry we're talking about is the adjusting entry, and then later on you'll have a cash entry to collect or pay the cash. The next category is the reclassification or deferral. For this situation, we've already had a cash transaction, and now we need to adjust it to recognize a portion of revenue or expense. So in this situation, the initial entry is a cash entry. That's not the adjusting entry, it's just a cash entry. The later entry is going to be the adjusting journal entry, and it's done at the end of the period. So there are a few rules to understand that will really help you through these adjusting entries. First of all, you have to at least have a revenue or expense account, and you have to at least have an asset or liability account. So there's an income statement account and a balance sheet account. We're trying to correct both. The other rule to understand here is that cash itself will never be in these adjusting entries. Cash will be in either the earlier entry or a later entry, but not the adjusting entry. But I do want to stress one important thing here. We're talking about these accrual-based adjusting entries, and there are 4 of them we're going to get into. 2 main categories with 2 apiece underneath those categories. There is a different type of adjusting entry that comes up in the next module. It's related to the bank reconciliation. Completely different situation. Even though they call it an adjusting entry, it's not the same type of adjusting entry. And of course, since it's bank reconciliation, that definitely involves cash. So just keep that in mind. For these core adjusting entries we're talking about, cash will not be in that adjusting entry. If you see cash in it, it must be a related entry, or it could be a related entry, but it's not the adjusting entry. So let's talk about one of the deferrals. We'll start with the 2 deferrals first. They tend to be the easiest. And this first one, deferred expenses, sometimes known as prepaid expenses, is by far your most common classification. This is a situation where you've bought something that you haven't yet used. You've bought an asset that won't be used for another, period of time. So we have a cash transaction first, but then the adjusting entry is used to reflect how much of that asset we've used up. Some examples would be prepaid rent, prepaid advertising, supplies, that's an asset that we haven't yet used up, depreciation of fixed assets, more or less the fixed assets are the prepaid, and then depreciation is the adjusting entry. So let's take a look at the example where a company prepays 1 year of rent at the end of year 1, $12,000, $1,000 per month. So on December of year 1, they're going to have a regular entry, not an adjusting entry, just a regular cash entry. They're debiting the prepaid rent asset to increase it, and crediting cash to decrease it because they're spending money. Now we are still in December. We're at the end of December now. We need to do an adjusting entry for just the period of time we've used. Just 1 month, December, out of that 12-month period. So it's only $1,000 out of the $12,000. Here is the adjusting entry. We debit the rent expense to increase it. We use rent, essentially, and we credit prepaid rent because we're decreasing that asset. It's gone. Now, in year 2, we have the other 11 months to use, the $11,000. It's the same debit, same credit. It's just a different dollar amount now. Let's look at supplies. That's a common one that virtually every company has. Here they buy $500 of supplies in December of year 1, and at the end of the period they have a remaining balance of $3,500. Assuming nothing else happened, they must have used the $1,500 difference in December. So here, when we first bought the supplies, again, this is not an adjusting entry. You can see it has cash. We debit the supplies asset for $5,000 to increase it. We credit the cash to decrease that because we paid cash. Now we're using $1,500 of those supplies in December. So now we debit supplies expense to increase that account, and we decrease supplies, which is an asset, to decrease that, we credit it to decrease it. Now let's get into long-term assets and depreciation. This company buys a $500,000 long-term asset in December of year 1. It's going to be used for 10 years, and it'll be depreciated for $50,000 per year. So we want to record the journal entry for the purchase of this asset in year 1. We're debiting the fixed asset to increase it. We're crediting the cash to decrease that. Again, assuming we paid cash. Then in the adjusting entry, now this is an odd one, for depreciation, it's a prepaid that we're now using up, so we have to debit depreciation expense for $50,000 to use up $50,000, basically 1/10 of this asset. We're spreading it equally over 10 years. Now the trick to depreciation, which we'll get into in later chapters, is we don't credit the equipment itself. Instead, we credit what's known as a contra asset, accumulated depreciation. This account on the balance sheet, as we'll see in the next slide, it offsets the value of that equipment. So instead of directly crediting equipment, we kind of indirectly credit accumulated depreciation, which still has the same effect ultimately of reducing the equipment's value. But what it's important to note here, any contra account, contra asset, for example, it has the opposite normal balance of what it's contra to. So by crediting accumulated depreciation, we are increasing accumulated depreciation, which then on the balance sheet serves to be a reduction to the fixed asset. So $500,000 fixed asset less this accumulated depreciation we've recorded means that our net book value is $450,000. No different than if we had just directly credited equipment, we'd still have an equipment value of $450,000. It's just another way of valuing it to show both the beginning balance and what we've used up of that asset. We'll cover this topic in 2 chapters from now in fixed assets. So now let's flip to the other side with deferred revenue. We talked about deferring expenses with the prepaids. Now we're deferring revenue with the unearned revenue. So with this one, we're the landlord, maybe, or we're the insurance company. We've collected rent early. Somebody prepaid rent for us. We're an insurance company. That's just by nature. It's almost always a prepayment. So here we've collected 1 year of rent in advance in December of 2020 or December of year 1, and for $12,000. Here we record the entry for the collection of the rent, which is not an adjusting entry. It's a cash entry. We debit cash for $12,000, and we credit unearned revenue, which is a liability account. The key word here is unearned. We owe this customer something. We owe them their service, or maybe we owe them their money back if we can't provide the service, letting them stay in the building. So we're increasing this liability for $12,000 until we actually earn the money over time. The adjusting entry would be to reflect when we've earned it. As 1 month passes, we've now earned $1,000 of that rent. We debit unearned revenue, the liability, to decrease that, and we credit rent revenue to increase that account. For year 2, we have 11 months to take care of, so 11,000, same debit, same credit. Debit the unearned revenue liability to decrease it, credit rent revenue to increase that. And now we're flipping over to the accruals. So remember, with the accrual, the very first entry you see is the adjusting entry. Cash will come later. So let's say here we have salary, by the way, is your most common one. Interest is second most common. Here you have employees that are paid $500 every week on Friday, $100 per day for a 5-day week. And we'll just use those round amounts. No, that doesn't seem like very much. They're part-time employees, perhaps. The next weekly Friday payday falls on January 2nd of year 2. So we need to reflect what they've earned in year 1. Basically Monday, Tuesday, and Wednesday, 3 of the 5 days. $100 per day, so that's $300 that the employees have earned throughout year 1. Now, keep in mind, they've already earned a lot of other stuff throughout the rest of year 1. We're just talking about this last pay period, this last week. So we need to debit salaries expense to increase it. We've incurred their expense because we've used up their labor, their benefit, but we're not paying them yet, so we have to credit salaries payable as a liability to increase that. Now in year 2, when payday actually happens on January 2nd of year 2, first of all, we need to remember that now 2 new days have passed that we need to record expense for. So we're debiting salaries expense for $200 more. But remember, we had that salaries payable set up last time. Now we're going to pay it off. So we're debiting salaries payable to decrease that, and we're crediting cash for the final $500 we're paying them. Again, this is not an entry, an adjusting entry. This is that subsequent entry after the initial adjusting entry. The fourth category is your least common one, but it certainly does happen. It's not extremely rare. We have interest, which is the most common way this could happen, but we also have unbilled but earned services. So let's say this company has $100,000 of services they provided in December of year 1, but due to their billing policy, they haven't yet billed for it, so they haven't recorded a journal entry yet, and they haven't collected it yet. By the way, hospitals are very common with this. They generally have policies where they don't bill until, let's just say, the 15th of the next month. That's their billing cycle. So for December, any service provided has not yet been recorded as earned, even though, yes, we've really earned it, we just haven't recorded it yet. And it won't be billed until the 15th of January, but that's too late for our financial statements. So we need to have an adjusting entry to force the recognition of that revenue. Interestingly, the entry is the same one that we would use when we did bill it. We would debit accounts receivable, the asset, to increase that, and we would credit revenue to increase that. So it's the same adjusting entry. It's the same entry. We just need to force it so we get this year's statements properly reported. Now, let's say that we've collected in year 2. All we need to do now is debit cash to increase our cash and credit accounts receivable to decrease that accounts receivable. So we're good to go there. So now that we've gone through the actual adjusting entries, we need to wrap up this portion so that we can move on to the financial statements. So what we would basically do here is record every adjusting entry we have, all those 4 categories. Each category might have multiple examples of that adjusting entry. We'd post all the adjusting entries to the T accounts, to the general ledger, and then we'd carry all of those adjusted account balances from the general ledger to the adjusted trial balance, which we'll see in another slide. And then we would use the numbers from the adjusted trial balance to carry over to create the financial statements. So let's take a look at an example of this. Let's just assume this is the adjusted trial balance now. And we have all of these assets all the way up to equipment. Those would go on the balance sheet. We just carry them over to the balance sheet. We have all of these liabilities all the way from accounts payable to bonds payable. Those would also go on the balance sheet as they are. We'd have common stock, which is $20,500. We have our retained earnings balance, which is $1,000. Now let me clarify something here. Common stock would go to the balance sheet. Retained earnings is the one tricky piece here. Retained earnings would go to the statement of retained earnings on the statement of changes in owner's equity. This is the beginning balance. That's a key thing to note. And then from there, we would add in our revenues, which, by the way, those go on both the income statement. Well, those go on the income statement. Our expenses also go on the income statement. The difference between those two would give us the net income. That would go on the statement of changes in owner's equity, the retained earnings statement. To add to retained earnings, we'd subtract dividends out of retained earnings, and that final retained earnings balance is what actually goes to the balance sheet. So that's a key thing. Retained earnings is the one thing whose balance does not go to the balance sheet. We have to adjust it first. We have to go through the retained earnings statement, which, as I said before, mimics the closing process. And I'll clarify that just a bit as well. Now, as far as cash, the only thing that goes on the cash flow statement is this ending balance of cash. And then we do our statement, we reconcile it to what the beginning balance of cash was, and we explain the change. So that's this portion of the accounting cycle. We complete the adjusted trial balance. And as you can see here, we completed the financial statements. And now we're moving on to the closing process. We're going to have journal entries for the closing process. We're going to have posting those journal entries to the ledger. And we'll complete one final post-closing trial balance. So as an overview of the closing process, what we're doing here is using data we've already used it for the financial statements, and now we need to set the next period back to 0 to start fresh. Now again, this is not every account. It's only our revenues, expenses, and dividends. They get closed out. Everything else keeps its balance. So we talked briefly at the beginning, what accounts are we going to close? So we have the permanent accounts, which are known as real accounts, sometimes even balance sheet accounts. Those do not get closed. We have the temporary accounts, sometimes known as nominal accounts or income statement accounts. Those do get closed. So the permanent accounts include all of your balance sheet accounts like assets, liabilities, and your 2 core equity accounts, capital/common stock and retained earnings. Those keep a balance until the company goes out of business. The temporary accounts, which are income statement accounts and dividends, revenues, expenses, and then dividends, those are all closed out to retained earnings. That's the goal. Now we have 2 options here. We have one option that creates this very, very temporary account that only shows up during the closing process. It's called income summary. And we could close revenues to income summary and then close expenses to income summary. And income summary basically gives us a net income figure that would match out to the income statement. And then we turn right around immediately to close the income summary account out to retained earnings. And then our last step would be close dividends to retained earnings. That's one option. The other option is to close revenues directly to retained earnings, just bypassing income summary, close expenses directly to retained earnings, and then close dividends to retained earnings. So the big question is, do you want this very temporary income summary account or not? It adds an extra step, as you can see here. Do we need it or not? Here we are going to use the account. We're going to use option 2, go directly to retained earnings. So the whole point of closing is to zero out an account and move that balance elsewhere, retained earnings. So to close revenues, to close any account, you have to find out whatever its balance is and do the exact opposite to it. Revenues in this case had a $1,500 starting balance. So if it had a $1,500 credit balance to start with, we've got to debit that account for $1,500, and that'll zero the account out. So the entry will be to debit revenues for $1,500. You see down here, the credit for $1,500 will go to retained earnings, which essentially moves that credit from revenues over to become a credit for retained earnings. But here's the journal entry that does that. Expenses, they have a debit balance to start with, so we have to credit it for $1,000 to close it. Credit expenses for $1,000, and the debit, of course, goes to retained earnings, which again essentially moves this debit balance for expenses over to become a debit in retained earnings. Dividends have the same basic journal entry. They start with a debit, so we have to credit dividends to close it. Credit dividends for $200, and we debit retained earnings for $200 for the other side of that entry. Now again, what we essentially have done is we took, whatever our beginning balance of retained earnings was from the trial balance, we added $1,500 into it, crediting retained earnings increases it. We subtracted $1,000 to close it out for the expenses. We subtracted $200 more for dividends, and we get an ending balance of retained earnings of $1,600. Now that is actually what's going to go onto the balance sheet at that point, and of course it'll be in the post-closing trial balance. Now what we have here is an example of a post-closing trial balance. I will mention this is not a continuation of the numbers we just used in the last few slides. It's just an example of what a post-closing trial balance might look like. So notably, we no longer see any revenues, expenses, or dividends. Instead, we only have assets, liabilities, and our 2 core equity accounts. The other thing to notice is that our earlier trial balance, our adjusting trial balance, had a beginning balance of retained earnings. The post-closing has an ending balance of retained earnings. The key thing is all of our debits and credits must balance out. This closing balance, this ending balance of retained earnings, would be after doing the closing entries. And in fact, that's the only of these listed accounts that would have changed during the closing process. The other ones, of course, would have been revenues, expenses, and dividends, which zero out and they don't show up on this statement. So, with this information, we move forward to January 1st of year 2, and we start our process all over. These accounts carry over. Revenues, expenses, and dividends start fresh with a 0. So that wraps up our discussion of the bookkeeping side of things. Module 3, we start talking about current assets, but hopefully this has helped to clarify this particular part of the topic. Very, very important part as you're heading into accounting. It's hard to get through any other module without really mastering at least the journal entries and the posting and the creation of trial balances. So, thanks for your time. I'll talk to you in the next module.